Hi, I'm Mike Romig with RCA Pension Advisors. I'm privileged to speak with you today about the Diagnostic Health Services 401k plan and how it can make a difference for you in your life. The DHS 401k plan is a government-approved and regulated retirement savings program. 401k plans like this are offered by thousands of companies across the United States and cover millions of employees like you who are using their plans to invest for their future. Your 401k plan allows you to set aside a portion of your pay on a pre-tax basis which is invested for your retirement. You decide the percentage of your pay you wish to contribute into the plan each pay period. The contributions are then deducted automatically from your paycheck and deposited into your plan account. Best of all, your 401k contributions can be deducted out of your pay before income taxes are calculated, so immediately your current taxable income is lowered. Additionally, the earnings on your account investments and the growth of your account accumulate tax-deferred until you withdraw your money, usually at retirement. As we get into the workings of your plan, I want to remind you that a comfortable retirement doesn't just happen. Social Security alone is not going to provide sufficient funds for you to retire comfortably. Your company's 401k plan is an exceptional opportunity for you to provide for your future with tax-deferred dollars. To participate in the plan, you have to first meet the eligibility requirements. You have to be at least 21 years of age, and you have to have worked for DHS for at least 1 year. Once you've met these requirements, you're able to join the plan on the first day of the month after you've become eligible. You can choose a percentage of your pay that you want deferred and contribute into your 401k plan account, or you can choose a fixed dollar amount that you'd like deducted from your paycheck each payday. In 2012, you're allowed to contribute up to $17,000 of your pay into your 401k account. Also, if you're over age 50, you can contribute an additional $5,500. You can periodically change the amount or percentage you contribute into the plan, and that policy will be described here when we have additional information. Once your salary deferral goes into your plan account, you decide how your account is to be invested. Your plan offers 16 mutual fund investment choices. Remember, a mutual fund is simply a giant pool of money invested for one particular purpose. The selection of mutual fund investment options available to you offer you the opportunity to invest in cash or in bonds or in stocks, and there are advantages and disadvantages to each. Cash investments are designed so that the share price of each dollar you invest remains at $1. That dollar earns a rate of interest, and that rate of interest can increase or decrease over time. What is most important about an investment in cash is the share price remaining stable at $1. The next type of investment available to you in your plan is bonds. Bonds are securities that are issued by the government or by large companies when they wish to borrow large amounts of money and they would like a longer time to repay it. Like cash, bonds pay interest. Unlike cash, because interest rates go up and down, and because bonds are not paid back for several years into the future, bond values can also go up or down. Historically, bonds have rewarded investors with higher rates of return than cash. The third type of investment available to you is stocks. Stocks are pieces of ownership in large companies. Companies like General Electric, Colgate, Walmart, McDonald's. What's important about stocks is they have returned more to investors over time than either bonds or cash. The challenge with stock is they can fluctuate in value, sometimes widely. In 2008, it was common for many stock funds to lose 20% or even 30% of their value. While most, if not all of this loss was restored in 2009, these fluctuations in value can be very stressful. I tell my clients the price to pay to receive the returns possible in stocks is the willingness to endure the swings in value. So the challenge in selecting our investments is to pick an assortment of stock funds, bond funds, or cash that on the one hand provide the growth necessary for our accounts to reach the level required to have a successful retirement. On the other hand, we have to have enough diversification so that wide swings in value don't cause us to panic and sell out at the worst possible time. To help with these choices, your plan is now offering a series of what are called target date funds. These target date funds are identified by a calendar year, such as 2015, 2025, all the way to 2050. These target date funds are comprised of a variety of stock funds, bond funds, and cash investments. The idea is to let the investment professionals at the mutual fund company determine what the best mix is so you don't have to. Typically, target date funds are designed to maximize growth opportunities in your earlier working years, and then as you approach retirement age, to become more conservative, to help stabilize your account and maintain your previous gains. The advantage of the target date funds is that you don't have to decide how to mix your investments. The fund company does that for you. If you're not really clear on how you want to allocate your account dollars, I recommend you pick the target date fund that most approximates your retirement age. If you're not clear as to the time and age that might be, I recommend you pick the target date fund closest to your 65th birthday or your 70th birthday, whichever seems to make the most sense to you. Next, I would like to talk about ownership of your account. In the plan literature, you may have seen the word vesting. Vesting is a pension term that means ownership of your account. You will always own 100% of the money that is deferred by you, and you will also always own 100% of the earnings on this money. Only any money ever contributed by the company has conditional ownership. Vesting in company contributions begins when you have completed 2 years of service and are 20% vested, and completes when you have completed 6 years of service and are then 100% vested. Now I would like to talk about when you take money out of the plan. The plan is designed to pay you at a benefit event. Given that this is a retirement plan, the most obvious event is your retirement. When you retire, your total account value will be paid to you. It can be paid in a lump sum, or we can structure a monthly payment for you. If you get sick or get injured and are unable to work, your account value can be paid to you. If you should die prior to retirement, your account value would be paid to your beneficiary. Anytime your account is paid to you as a benefit, the amount you receive will be taxed as ordinary income. Remember, our contributions into the plan originally were tax deductible. While you are still working, you can also access your account should a financial hardship occur. You can borrow up to 50% of your vested account balance, not greater than $50,000. This loan, which is not taxable to you, must be paid back through payroll deduction over the next 5 years. If you have already made a loan in a financial hardship strike, you may make a withdrawal from the plan. The hardship definition is very rigid. You can only withdraw the dollar amount of the hardship, and you must pay taxes on what you receive. Additionally, if you're younger than 59 and a half, you must pay the IRS a 10% penalty. If you leave this company prior to your retirement, you have 3 options available to you for your retirement plan account. If you go to work for another company and that company has a 401k plan, you can have the DHS plan send your account balance to your new company's 401k plan. That is a tax-free transfer. You could establish an individual retirement account, an IRA, which you could do with your personal financial advisor, your bank, or we would be happy to do that for you. In that case, you would instruct this plan to send your account balance to your IRA. This also is a tax-free transfer. Your third option would be to request a check for the value of your account. If you select that option, you will have to pay ordinary income taxes on the entire amount you receive, and if you're under age 59 and a half, the government is going to charge you an additional 10% penalty. Also, if you take cash distribution from your plan, the company is required to withhold 20% for taxes, just as the company is required to withhold income taxes from your paycheck each pay period. Remember, a comfortable retirement doesn't just happen. Social Security alone is not going to provide sufficient funds for you to retire comfortably. Your company's 401k plan is an exceptional opportunity for you to provide for your future with tax-deferred dollars. Convenient payroll deduction and a lower tax bill make this the perfect opportunity for you to accumulate money for retirement. Thanks for your attention. My contact information is on the screen. I or one of my associates is available to speak with you either in person or by phone at your convenience. It's important to us and it's important to DHS that all your questions or concerns are addressed. So please feel free to call or send an email anytime you have a question. And once again, thanks.